Yeah, somehow the LinkedIn. Okay, it just popped up.
Planned really.
Okay, I see 3 people on LinkedIn. Okay. Surprisingly, this might be it.
Took a while to set up and
Yeah.
you're finally ready.
I know. It's like live streamed all this. I think people should be able to hear you. Okay. I think it should be good now. Cool. Let's go. We are. I need to have my Coke.
Yeah.
You need one?
No, I'm okay for now.
Okay, I'm gonna celebrate this. Oh my god. Like, why do we take such challenges up, Shankar? Why do we take such challenges that put us on the spot? Isn't life hard already? Oh my god. Okay, so today, welcome everyone. Those who are live, this is first time we're doing it. As you can tell, I'm a newbie. I'm trying to figure everything out, and today we have Shankar Madhavan, somebody I've known for close to 8 years now.
Yeah.
And I can openly say that this single person probably had more impact on my net worth than anything else.
That's very kind, Nikhil.
I'm pretty sure Shankar added a few $100,000 to my net worth. And he was somebody who was willing to break open the whole finances, personal finance, things like mortgage, things like investing, just the overwhelming concept of what you do with money once you have it in life. First of all, you're very privileged to if you have that money, but what do you do with it? He was the first guy who opened up the concept that, okay, it is okay to talk about money. It is really okay to go in depth about money. And I just wanted to say thank you for, taking me through that path, or at least setting me up on that path of like, okay, this is possible. It's not that difficult. It's not like you need a finance degree and, get an MBA or whatever, like, join a finance bank. I wanted to start asking this question to you, Shankar, is do you think it's realistic for a person who's having a 95 to be able to invest and make decent enough returns?
I think it's definitely possible. I'm an example. I think so. When I started, giving a little bit of background, right? In my early 20s, I was young and stupid, like making a lot of money mistakes. That's where it all started. So at some point, I was like, I can't live like this. This is just not, a good way to live. And then, you have that realization. Then I was trying to streamline what I was doing with money. And as I did it, the first thing was I was just trying to learn the basics. I think the first kind of things that I was going for was, 100 ways to make $1,000. Like very tactical, the basic books that kind of like the self-help
Rich Dad,
money.
Poor Dad.
Yeah. So those were the,
Right.
first few.
Right.
And this is kind of like the early times of internet, right?
Yeah.
So, looking for books on, like in bookshops and so on. And what you find there is all like the most tactical ones, because that's what sells.
Yeah.
Catchy titles, tactical ones. And then I think over a period of time, like if you go deep enough with money, you somewhere along the line end up with, Warren Buffett, Charlie Munger.
Yeah.
So you go deeper chasing several rabbit holes. And that's what happened to me. I think it has been now like a 15 plus years journey on,
Wow.
like figuring this out. And I don't consider myself anywhere close to being an expert, I would say.
Yeah.
So, like, still a student, still learning. And throughout this period, like, I've, had a job and, tried to do all of this on the side. So I think one of the fundamental principle is just keep pursuing your curiosity. That's what helped me. Like, I would, okay, how do I do this? Then go deeper and deeper.
Yeah.
And then how do I do mortgage? How should I think about buying a car? How should I think about, like, all of these
Right.
questions?
It's like step by step, right?
Exactly. And then once you start saving a bit and you have this excess money, then you start making money work for you. So, and also there, of course, I went through like all sort of phases, right? Like when anybody, like, I don't know, like 10 to 12 years ago, anybody comes and presents me an idea of, here is an opportunity to make money,
Yeah.
I would listen to it. Like, meaning in a bad way.
Yeah.
In a bad way, because I think over a period of time, you realize, you're saying no to a lot more things because you have clarity of thought.
Right.
But early stages, when your knowledge is, kind of a bit lower,
Right. It's
you're
not
saying
built. It's not built on a foundation, right? So any idea that comes in that seems attractive, that you're like, oh, let me
Exactly.
figure this out. Oh, this
Exactly.
seems like a good way to make. My first venture into investing was Bitcoin. And why? Because I sat in this table in Amazon Prague, and my guy on the left was buying Bitcoins, and the guy in front of me was buying Bitcoins. And I was like, okay, this is how you make money. Two guys I know are making, and
Exactly.
I went in,
Uh-huh.
and I lost money, and I was like, that was so stupid. Like, you are such a smart guy. Like, who is an analyst at Amazon? You can think through these things. And that's when I was like, okay, I will not do anything that I find the first thing, the first path to making money. I will not do it. I will wait it out. I'm not in a hurry. And I was 23 and I lost like, I think I invested, my first investment was like €1,500. So that was my 1 month salary. I lost like $500 because the Bitcoin crashed. And I was like, okay. Then I didn't sell it and it came back up. So I basically evened out by the time I exited. But like, this is so stupid. Like, I have no idea what I'm doing.
Exactly. So I think I was along the same path.
Yeah.
A lot of these early mistakes, investment opportunities, like, so to say, investment opportunities. And then once your knowledge gets better and better,
Right.
you see through these things so easily. Like, what makes sense,
Yeah.
what does not make sense. And because, your fundamentals are so strong, what's relevant and what's not relevant anymore. So I think that's how my journey was built. And if I can do it, anybody can do it. Like, I don't think it's, hard at all. But you need to stay invested in terms of like building your knowledge. I think that's the foundation, because once you build the knowledge, once your fundamental mental models are strong, you can very easily apply it to any scenario. That's how I think about it.
Yeah, and it's something that you would see that when you actually invited us to come to Berkshire in Omaha, it was remarkable. Like, there were these 60-year-old guys, CEOs worth hundreds of millions of dollars, and the openness they had to learning. Nobody came in, at least in those settings, like, oh, I know how the business works, I can value anything, and I can read reports. They all had a different perspective, and they were willing to learn. We remember this meeting with Brett Kelly. Like, we were like, why is this guy talking to us? Like, I was 27, 28 at Amazon, and this guy is a CEO of Kelly Partners, worth at that time, roughly maybe 150, 100 million dollars
Yeah.
personally, because he
Yeah.
owns 50%
Yeah.
or more of the company. He's spending time with us, asking us questions
Uh-huh.
on how we work at Amazon and what. I'm like, this is crazy.
Yeah, I think Berkshire is a very unique tribe because it attracts like-minded people, and like it kind of brings together people who share similar values, and everybody is open to learning new things. So I think Berkshire is a very unique tribe, and I'm so happy that like we got to
But you
go
have
there
to
together.
understand, like for me, I had at that point in time when I went for Berkshire annual meeting, I never even read a report.
Mm-hmm.
And I'm going to Berkshire thinking that I'm going to be surrounded by these like super rich people who know what they're doing.
Mm-hmm.
And I'm like, I was pretty nervous. Like, what do you ask in a meeting, or what do you expect? But we had heard enough of those meetings. I felt comfortable when the meeting started. But that whole experience, like, I can't. And I agree with you. Berkshire is an outlier. You can't go to any annual meeting and have the same experience. But to me, that was very remarkable that this world of finance, to me as a 23-year-old, felt so strange. It was within those suits and those buildings and within Excels. But then you understood, okay, this is all one way of doing it. And the other ways is possible. So for me, I think it is also totally possible that you could be a very good investor with your 9 to 5 job. Quick question. How many trades have you made in this year? What would you say? How many buys or sells did you make a decision on?
Maybe 2 buys, I think.
In the whole year?
In the whole year. I think it's very low since COVID. I think in the last 4-5 years,
Right.
probably 5-6 buys.
In 5 so that to me is crazy, right? So my understanding of finance was from my dad and my uncle, like my grandpa, who still invests. They would make 4 buy decisions and 5 buy sell decisions in a day.
Yeah, I think like these are things that Berkshire really, like Warren Buffett's way of thinking, really tunes your mind, right? Like in my own investing journey, of course I did all of this early in my early days of investing, right? Like, oh, I look at this stock ticker, like compared to what I like today, maybe 2 months once or so I look at my investment portfolio. I'm not even bothered because I understand what I'm invested in, and I don't see a need to check my portfolio, and there is no FOMO, like in general. Like I don't care about what else is happening in the market because I'm so focused on companies that I've understood over several years, and there is no interest. Like my investable universe is so small.
Right.
Everything else just doesn't
It's
matter. So there's a story of the Lord Krishna and Arjuna, right? Like his guru Drona and Arjuna.
Yeah.
He says, like, what do you? He asks every student, like, what do you see? Everybody's like, okay, I see the tree, I see the leaves, I see the world, and Arjuna is like, I see nothing. I see the eye of the bird.
Yeah.
And okay, so that's the focus.
Yeah. Eye of the fish, right? It's like the
exactly. So he says, okay, so then fire your arrow. So the idea is once you know what's your competence, then you just stick to that. Everything else just doesn't matter. Like everything else is a distraction. So that's also why, like for example, even now, I know like Nvidia has been a lot of interest in Nvidia. I don't think I've ever read any news article about Nvidia in the last like 2 years or so, because it's just not an area that I'm investing. I'm not interested in it.
Right.
But that there is part of the market where there is a lot of noise and people just get attracted to this, right? Like it's like you place something sweet and then ants just come.
Yeah.
It's kind of like, but if you're an investor, like while everybody is focused on Nvidia, I'm reading annual report of a French, wine cask maker,
Yeah.
and this company is like 75% owned by a family that has been running it for 200 years. And they're kind of like, there's like a handful of companies that make these wine casks.
Right.
And they kind of have a very consistent market share across the globe. So there are only like, companies that you can count using, few fingers in your hand,
Yeah.
that make these casks where you store wine and, you age them and,
Right.
like, you store whiskey barrels, etc. So those are companies nobody writes about, nobody talks about them.
Yeah.
It's not fashionable to talk about
Right.
them.
Exactly.
But my area of interest is exactly those kind of companies. I'm interested in companies that nobody's interested in. I think that's, and you have no competition. You don't have to, you're not arguing with anybody. Like,
Right.
you don't get distracted by all the articles showing up in the internet.
Yeah.
So I think that's very important. You understand simple businesses and just stay within those boundaries. Yeah.
And I think most often, again, for techies, it seems like, oh, I'm in the tech world. I don't understand anything else. I can understand what AI does. And that's where I think a lot of false confidence comes in. And that brings me to a point that I was recently talking to somebody about. After working for 10 years at Amazon, my portfolio of Amazon has gone from 100%. So basically about the year 1, 2, 3, 4. So until the year 4, it was 100%. My only stock that I owned was Amazon. And then you came in. And since you came in, it's been going down. So the portfolio percentage, like out of the, let's say I have $100 invested. Out of the $100, I have $6 at tech, which includes Amazon. So it's only 6%. I'm wondering for you, as somebody who's working at Amazon for close to 15 years, what is your Amazon or your tech portfolio percentage?
Probably about 15%.
15%.
Yeah.
So
15%, that's purely because, quite a fair share of my compensation comes out of Amazon's RSUs. And that's driving the 15%. I think my non-Amazon tech is like, low single digits.
Yeah.
So that's because.
But do you keep the RSUs or do you always just sell to buy stuff?
I think for several years I just sold. That's also because that was a mistake for sure. Yeah, because I think if I had kept them invested, that would have been a disproportionate
5x
return.
yeah.
Yeah, exactly. That said, I think at a point when I realized that Amazon is, reasonably valued, it makes no sense to sell anymore. And when I say valued, generally people immediately associate it with the stock price. I'm not talking about the stock price. I'm talking about actual valuation of the company. Like, for example, how do you value a building? Like, how do you say a building is worth, I don't know, $500,000, right? Like, you actually value the land, then you value the material, then you value, like
nearby
property
lands.
nearby. Exactly,
Yeah.
exactly. So once you know, I think for me also, understanding how to value a company took time. And once I got to that point, I think in the current levels, I wouldn't sell Amazon shares because I don't think they're very attractive. Like, I'm not buying anything new.
Yeah.
It did get very interesting about 6 months ago.
Right.
And at that point, if it went down even further, I would have bought it. But I think there are times when I felt Amazon was overvalued.
Right.
That's probably why, I sold at that point in time.
Right.
But over a period of time, my understanding of valuing companies got better. And with the knowledge that I have today, I would not sell Amazon at all.
Yeah.
And, like I don't prefer giving predictions because, people always,
You
like,
said
yeah, exactly.
6 months ago. Yeah.
But at the current state Amazon is at, I feel very strongly about what Amazon would do over the next 10 years.
Interesting.
And this is just like pure arithmetic, like, what Amazon has done in the past, and ignore all the AI spending,
Yeah.
right? People always talk about, oh, what about the AI spending?
Yeah.
Like, Amazon is spending 200 billion in the larger scheme of things is just pocket change. Like, it doesn't, like, if
Yeah.
you look at Amazon
Yeah, as a
financial
whole,
statements, you would really see that what, the amount of cash Amazon has versus, the investments that some of these companies are making. Yes, it's capital intensive, but the value is just disproportionate. Like, think of it this way, right? Like, always return on capital. That's the most fundamental measure for you to buy a solid business. Like, for example, think of it this way, right? Once Microsoft builds Microsoft Office and Windows, that's a one-time cost. They can keep,
Yeah.
you know,
Licensing.
yeah, licensing it for the next 4 or 5 years, like, typical life cycle of some of these softwares, and it costs them nothing incrementally. Like,
Right.
of course, sometimes they put it on DVD and you pay for the cost of DVD,
Yeah.
but Microsoft literally prints money on businesses like these. I think that's the important thing. Like, you need to look for businesses where return on capital employed is very attractive. To me, that's one of the important criteria that I consider while making investments in a
Yeah.
stock.
Interesting. I think, as you said, like the tech, not just tech, the companies and their portfolios, and it fluctuates over time, but also so does your knowledge.
Yeah.
And it has to meet at a place where you feel confident enough. It enters a circle of confidence by either the company entering it because
Yeah.
they made certain changes, or your circle of confidence expanding
Yeah.
to include
I
that.
think also, I think in general, at least in my case, I do think, we as humans have this tendency to overestimate what we can do. Like, we need to be true to ourselves on, to me, like, my investable universe. Like, for example, I have certain, conditions that I apply. And when I put my conditions on some of these, like, screening tools,
Yeah.
etc. Like, for example, in India, once I put my conditions in, I think India has like 4,000 or 5,000 stocks listed
Right.
in the exchanges. My investable universe is, I think, 200 and something. And even within the 200, what I truly understand, their business model, etc., is probably about 50. And of the 50, maybe there are 20 that are in a like
Healthy
pure
state.
comfort, comfortable position, etc. Then of the 20, maybe like 5 are in a valuation that's interesting.
Right.
And you're not doing analysis at a time when it's interesting, right? Like, your knowledge is built over several years, and you're just waiting patiently for some of these companies to get punished by the market, and then you're taking advantage of these
Right. So very like a
disproportionate
laid
pricing.
back, lazy approach. What
Exactly.
you're taking is like you're reducing your horizon from 6,000 to 200 to 20, and being like, I'm just gonna watch these 20 companies.
Exactly. I think my broader horizon is probably about, so personally, I also find it very hard to read and learn and track anything more than 20 plus companies at any point in time. Like, it just becomes too much of an
Yeah.
effort to be
Yeah.
able to do that. And honestly, I think Buffett said this at some point. He said, like, you don't really need even 20 different ideas.
Yeah.
You need like 2 or 3 in your lifetime that are really going to be a game changer.
Right.
And then you create like wealth for 2 generations or
Yeah.
something like that. So I think starting early is important. Of course, power of compounding. The more years
Right.
you have, it helps you. The other thing is just sticking to some really good companies and just be patient.
Yeah.
You'll find time. You'll find a time will come when you can make big bets, and when the time comes, don't be fearful.
Yeah.
Just make some big
Yeah.
bets.
Load
Once
up
you
the
make the
truck.
big, yeah, once you make the big bets, they'll play out. Like it just, you just have to, like as Charlie Munger says, like sit on your ass investing, right? Like you
Yeah.
just buy, sit tight, and then things will play out.
And you've like helped a ton of people, right? I remember you were doing this in Amazon Luxembourg where you would have these sessions and the people would come in and you would not have an agenda because you're not a finance guy. Like you're not a fund manager or you have no incentive.
Yeah,
You genuinely want to educate people and people see through that because you don't sell a course, you don't sell a workshop that this is how you should be investing. So you've helped a lot of people. Tell me the number one people mistake. Tell me the number one mistake that new investors make when they enter this world of investing, especially around the time when they've made their first big money. It could be landing a good job or some inheritance. What's the number one mistake people make?
I think one of the key things that I repeatedly see is getting carried away by noise in the system. Um, because so why does that happen, right? Why do people get carried away by noise? That's purely because of lack of the fundamental knowledge. Because once you know the fundamentals, strong enough, you're not distracted by, some. So I do want to make a comparison, right? Like when somebody buys a house, for example, they would do research for anywhere between 6 months to 1 year. So they look at, public transport, school district. They look at, okay, safety in the neighborhood. Who are my neighbors? Like, what is the, I don't know, crime rate, etc. Then they're looking at flooding risk, risk of, I don't know, fire, risk of, then how's the builder? What's the material quality? How many years of warranty would I have on these things? Do I have issues with the roof, like heating system? So they do, like, you ask any human, any adult, if you give them an hour to think, they'll bring all these parameters in.
Yeah.
Because it's so logical, and you will not see any adult like thinking in an irresponsible way about buying a house, like most adults, like 99+%. On the other hand, people get really carried away when they buy stocks. So nobody goes out and buys a house because somebody gave them a tip on a Tuesday. Like that just doesn't
That's
happen.
my Bitcoin story. Like the guy next to me bought Bitcoin. I'm like, that's the way to go. I go buy Bitcoin.
And like you can extend that even further, right? Like nobody buys or sells houses, 3 times within 3 weeks because the house price went up or down. Like we all think very rationally when it comes to house. Just because it's easy, we end up doing a lot of mistakes when it comes to stock investing. So, like, if somebody owns a house, you could just go to one of these online real estate portals and figure out how much, your house price has changed over the last 6 months, last 1 year. But just because your house value went up by, let's say you bought a house for, $50,000, $500,000, and then your house price went up by 50,000 in a year, you're not going to sell and move out. Like, oh, I made 10% on this. Let me get out of it. Like, we would never think of it that way. For some reason, we always think of it that way when it comes to
I think
stocks.
that's a great point, right? Like, I think this is what maybe Buffett also refers to is because it's just one button on an app. If it was that way of buying this house, you don't have to physically move and you can just buy, sell, buy, sell. I think people will do it. I think it's an interesting point that earlier it was like you had to at least be at the brokerage. There's still some friction. But I agree. Always the friction has been too less compared to these real assets that you need to, notary and like this is a whole process.
I think that's one component, right? The ease of access. That's
Yeah.
one component. The other component is everybody looks at a stock. Like you can ask anybody, they'll be, um, for example, right? Stocks in my portfolio, I can tell you what are their market caps because market cap is the total value of how much the company is worth. I cannot tell you the stock price
Yeah, exactly.
because I just don't know. Like I don't think of it in that terms at all. Like
Exactly.
because I look at the market cap and that's what I remember because you need to think like an owner. You're owning the entire business. But anybody who is generally speculating in the market,
Yeah,
all they'll remember is the
Is the
stock
stock
price.
price. Yeah.
And they cannot usually tell you any other important detail. Let's take an example, right? I use this example very often in my workshops where I tell people, think about buying the bakery that's at the corner of your street. How would you make a decision about buying the bakery, in the corner of your
Yeah.
street? First, you need to know how much profits is it making.
Right.
How much will you pay for it? And people usually have, like, if you give them enough time, they will think of it the right way. Okay, so this business is making $10,000 a month. If that is the case, in a year, it's making 120K. So I'm willing to pay, I don't know, 250K because over 2 years I can make the money back. Nobody talks about a stock that way.
Right.
That's exactly how you should be thinking about a stock. But when it comes to buying a business or buying a house, people immediately get the concept because it sounds very logical.
Right.
For some reason, stock feels like, okay, just put some money and see where it goes.
Exactly. It's very interesting.
Yeah.
I think, yeah, because it's so cheap
Mm-hmm.
in a way, right? You're buying 1/1,000,000th
Yeah.
of a, so you never even think about the whole
Yeah.
big
Yeah.
elephant, right? You're
Yeah.
just thinking, oh, I just want my 2 stock shares that are at 150 to just move to 170 so I can make $40.
Yeah.
And
So
that's the mindset that I grew up
Exactly.
in my house with. It's like, I was like, this is so stressful. Like,
so one another like suggestion that I give to people is like people know I like talking about personal finance and stuff. So a lot of people come and talk about like specific stocks. The over a period of time I developed this line that I use very often. I always tell people if you don't have at least 3 months of your income equivalent in a stock, don't even talk to me about it. So that's
So-
my mental model.
so it's
because-
basically you need to have skin in the game, right?
Exactly. So I'm telling them, if you put $1,000 into a stock, and if you want to talk to me about it for half an hour, like let's not
is
waste
not
each
worth
other's
it.
time. Yeah.
Right.
But let's say you're making 10,000 a month, and you did put 30,000. Okay, that's decent enough money
Right.
where you're not probably speculating.
Right.
You're trying to invest. Okay, I'm willing to have a conversation. So that's where I draw my line.
Yeah.
You can stretch it out like as
Right,
people, age,
Right, right.
It's
No, that's a
much
good
bigger.
point. I think, and maybe that's how you should think about investing as well. If you're not willing to bet 3 months of your income, you're just like, I make 30,000 a month. I'm just gonna put 3,000.
Yeah.
Then don't do it. Don't
like,
do it.
the-
Yeah.
So I think at that point in time, you should be like how Ben Graham talked about it, right? There is investment and then there is speculation.
Right.
So investment is where you value a business and you see an opportunity. Market is valuing it much lower than what you would value it. Then you are investing. And the other side is speculation,
Right.
where you are literally gambling. Like you're
Right.
putting money, you think there is an upside,
Right.
so you're putting in money. It's okay. Like I
Yeah,
don't
just
think
don't
this-
treat it that other way, right?
Exactly. And I think, if you're a rational
Yeah.
human being, then at some point your investments will be, I don't know, like 90+%. And then your speculation will be 10%
Right.
of your, you shouldn't be gambling with more than,
Yeah.
that ratio in general.
Yeah, it's-
but
But
yeah.
again, it comes back to self-awareness, right?
Exactly.
Like, just
exactly.
be aware that you're just gambling and it's okay. It's your money,
Exactly.
but
So
don't confuse.
in the Intelligent Investor book, Ben Graham even goes even further and he says, keep separate accounts. That way you drive the discipline,
Right.
keep two different brokerage accounts.
Right,
In
one for
one, just
gambling.
do investment.
Yeah.
The other one, do
Exactly.
all the speculation you want. Like,
Yeah.
don't put half your wealth into it.
Exactly.
That's the key. Yeah.
So tell me, in a quick way, like what do you think are the 3 ways that people should be understanding to analyze a company? And you mentioned some of them previously, like think of the company as a whole.
Yeah.
But talk to me about like what are the top 3 ways you would say quickly for people to start having an understanding that this is also a way to invest.
I think going back to the real estate example, right? Like I always use the real estate example because it becomes very logical and easy to understand for people. How would you decide if a house is an investment that's good enough for a rental property, for example, right? How would you make a decision? You buy a house for, let's say, 100,000, and then if it's making 10,000 a year, like $1,000 a month approximately, let's say, then is that a good investment? People logically think about it well because people know that okay, this 100,000 worth house, based on property price increases, I don't know, making 10% growth,
Right.
and then so 7 years later it's going to double.
Right.
Rule of 72 by 10%. So 7 years it's going to double. 100,000 is going to become 200,000. Your rental yield is going to be whatever, and people with reasonable intelligence will get to an answer of okay, here is how much it's going to make in rental yield. So it is worth as an investment.
Right.
It's the exact same way to think about companies as well. So
Yeah.
the way I would say is the first thing is see how much is the company worth in total, which is the market cap of the company.
Right.
Personally, I don't buy companies where the company has more than 2 years income as loans. Like simplistic way. So think about even humans, right? If there is a human who makes 50,000 a year, for example, and
the
if
loan on
that
them
person
is that.
has non-mortgage loans of 100,000,
Yeah.
then that person is bad with their money. Like it's
Right.
simple as that. It's the same thing for companies. Like,
Right.
and that's just my personal rule, right? Like some people go even more
Exactly.
aggressive. Like I would prefer companies that have zero
Zero.
loans, but I'll go maximum up to 2 years worth of
Right.
2 years income equivalent loan. Okay, I know they can repay. It's
Right.
not difficult for
Right.
them to repay. Anything
Right.
beyond that,
It's like if you have a car,
yeah,
right? If you have a car at 8 lakhs per annum, if you're running like 8 lakhs is close to $8,000 per year.
yeah.
And if you're buying a car which is 25 lakhs,
Exactly.
Yeah, you're
So
kind
my own thumb rule for car is very aggressive. So my own thumb rule for car is 3 times your net pay, net monthly income.
right.
That's my limit, and
Yeah,
that's
so
my
basically this
personal rule.
translates to companies as well, right? Like
Yeah.
how much debt are they taking?
Exactly. So that's the second,
Yeah.
like important line for me. Then comes the 3 core financial statements, and you do need some understanding of accounting. Like if you don't know basic accounting, like it's not easy to understand.
What's
these,
the how would you recommend this step? Because I feel a lot of people feel very troubled by I don't want to do accounting, finance, techies, or non-tech people even they feel very overwhelmed
Yeah.
by these numbers
So
or
I think so. This is where the quality of companies come into picture, right? Like if a company's financial statement looks confusing, it's meant to be confusing. So there's so much going on. The company doesn't want you to understand what's
Right.
going on. So I think clean accounting and good governance is very important. On the question of how do you learn, I don't think there are like very easy shortcuts.
Right.
If you really want to do investing by understanding the value of companies, you need to learn basic accounting. There is no two ways about it. And there are so many, like, you could go to Udemy or like,
Right.
these portals and take some basic accounting classes. Like, in like 10 hours, you could get at least the basics.
So if you have to make money, you have to put in some effort.
Exactly,
Unfortunately.
exactly. And that's why if you want to be an active investor, this is what you should do. If you don't have the time or don't have the skills to do it, just invest in an index. You're done.
Yeah.
Like, you
so
don't
talking
need
about
to.
those two things. One is you said the rule of 72. What is the rule of 72?
So, rule of 72 is the easy way to calculate how quickly your money doubles. So, here's how,
So, like-
Pabrai explains it. Monish Pabrai, like one of the, investors that I learned a lot from, says this, in a very simplistic way, right? Like, for example, if, a bank, gives you, in Europe, for example, 2%. So, which means that 72 by 2, which means gives you the number of years to double your money. So, if you put in 1,000 euros, 72 by 2 is 36 years. So, it means that $1,000 will be, 1,000 euros will become 2,000 euros in 36 years. So, you use that to calculate, how many years the money doubles. For example, right? I gave this example to my son, when he was, I think, 8 years old or something. So I told him, hey, I'm going to give you 1,000 euros now, and you will not touch it until you are 68. So,
Okay.
which means that you're
60
8 years now,
Yeah.
60 years. And I, like 15% returns is not doable, like, except for, the god of investing like Warren Buffett. But let's just take this for practical example, right? Let's say over the 60-year period, we're able to do 15%, as a
Right.
hypothetical number. Now, how do you calculate, how much is it going to be after, 68, right? Like when he reaches 68. So the easiest way to do this is 72 by 15. Let's just round it off. 75 by 15 is 5 years.
5,
So every
yeah.
5-year money doubles.
Okay.
So 60 years, 12 doubles.
So basically in 60 years, since the money's doubling every 5 years,
Exactly.
you're saying it will double 12 times.
Exactly.
So that means that it went from $1,000 to 2,000 in year 5 to 4,000
exactly.
in year 10.
So 4, 8, 16, 32,
Yeah.
and so on. So now how do you calculate,
Yeah.
what do you end up with, right? So it's, the formula is your starting number, which is the 1,000 euros that I give my son, multiplied by 2 to the power of,
12.
number of
Yeah.
doubles. So 2 to the power of 12. So for all, people who studied binary computer science, etc., 2 to the power of 10 is 1,024, and 2 to the power of, 11 is 2,048, and then 4,096.
Yeah.
So you multiply 1,000 by 4,000, so that's 4 million euros.
Wow.
So if my son starts with 1,000 euros, and if you're magical reason able to deliver 15%,
Yeah.
when he's 68 with no additional investments, he would have 4+ million
Right.
euros.
But if you look at those two numbers, it doesn't make sense. Like,
Yeah.
how can you get 4 million from 1,000?
Exactly.
And
exactly.
that's the power of
And that's the
years.
power of compounding.
Right.
So compounding needs a couple of things, right? 3 things actually. One, you need enough runway. So
Right.
you need
Length
to
of
have
time.
as many
Yeah.
years as possible. So starting early makes sense.
Right.
And then second thing is you need a good starting capital. So
Right.
so if you're somebody starting now, then save as much as possible and then invest. The third thing is the rate of interest, like,
Right.
rate at which your money grows. So for the rate, I think the important thing is keeping money in the bank is bad idea
Right.
because banks give you very little interest. And historically, it has been proven that stock market is one of the ways to compound wealth at a much higher rate
Right.
than any other, assets. Like, real estates have delivered 4-5%.
Yeah.
Gold over, I think like a century plus has delivered $5% on, like, constant currency basis, etc. So none of the other asset classes match what stock markets can deliver. And that's why investing in the stock markets is the right thing to do. However, one word of caution: if you cannot live through 30% falls, 50% falls, etc., personal finance is very personal.
Yeah.
You need to do what lets you sleep peacefully at
Right.
night. If you are somebody who cannot deal with 50%
Yeah.
crash in your portfolio, you shouldn't probably be investing in the stock market.
Right.
Like, you're better off keeping the money in the bank, or
Yeah.
like whatever other ways, right? So you need to understand that investing in stock market is a roller coaster ride.
Right.
If you're up for the roller coaster ride, then the
Yeah.
rewards are
Again,
going to be
there's
substantial. as well.
Self-awareness,
Yeah,
right?
exactly.
And
exactly.
indexing is essentially just like,
Yeah.
don't pick winners, but just pick the whole market.
Exactly. So indexing is nothing but, if you don't have the skills or
Yeah.
you don't have the time, then you're just buying a basket of, some of the top companies in US, for example. So you
Right.
could buy the US index, or India index versus
Yeah.
global index, etc. You buy the index and you're betting on that particular country or that
Right.
particular economy to do well over a period of time. So for people who don't have the time or the skills, that's the best way to do it.
Right.
If you have the time and if you have the skills,
Then it's worse.
then look at analyzing individual companies, and over a long period of time you build the knowledge, and once you build the knowledge, then you're probably going to be able to beat the index. So
Yeah.
yeah.
Do you think so? This concept of financial independence, retirement early, FIRE, like it has grown like fire, right? It has. Everybody's talking about it. I see number of sub threads and Reddits like about people being so focused on FIRE. Do you think it is really possible for 9 to 5ers like to get to FIRE, and is it worth it? Like, in your head, are we? It is like only a half glass full that you're looking at with the FIRE number. That most people get it wrong. That they're just chasing the number, but there's a whole philosophy behind financial
Yeah.
independence.
Yeah, I think as a concept I understand why people want it, because people are like, I don't want to keep doing what I'm doing
Right.
today, so I need the freedom to be able to do what I want to do, and that's why I want to get to that point as quickly as possible. I understand that,
Yeah.
like why people think about it. I think my own way of thinking about it is, even before you think about FIRE, I think the most important thing is try and figure out your purpose.
Right.
I think that's more important. Once you,
And harder,
yeah, it's harder. Yeah, it's
right?
definitely
Because
harder.
it's not a number.
Yeah.
It's a very
So
qualitative.
yeah, exactly. Figure out purpose of your life, or what you really enjoy doing, and then you're not thinking about retirement in like pure retirement sense. You're thinking about, okay, so I am doing what I really love and enjoy. Now how do I make sure like my finances are taken care of?
Right.
Like, that's how you're thinking about it. So that's one fundamental thing.
Yeah.
I think the second thing is, you need to understand uh, what are your true expenses. Like the Trinity study, which is the most popular one that people talk about, is 4% withdrawal rate, like, which essentially means whatever is your annual expense, you need to have 25 times that as a capital that's invested in like an index fund or something.
Right.
So that the index fund grows at 8-9%, you're withdrawing only 4%. So even if you end up living until age 200, you will never run out of money. So that's the concept. I think there are like some nuances to it, like that people should really think about, which is, okay, what next? Like what, like once I get there, what is gonna,
Right.
what am I going to be doing, etc.
It's only part of the puzzle you're solving.
Exactly,
Right?
exactly. And also, you need not try to, like, most of the time people get overwhelmed by this. Oh, at 25
Yeah.
times my annual income.
It's too much.
No,
Yeah.
annual expense. It feels like too much. But you need to think about, okay, so maybe your expenses are not going to be that crazy as age, because, kids are grown up, kids are out of the house,
Right.
your own expenses, you have a mortgage that's fully paid off, then your
Yeah.
house related expenses are gone. So you need to plan for whatever time you want to become fully
Right.
financially independent. But a lot of times, once you like write it down, you realize uh, it's not as bad as people think of it. Like I
Right.
generally see people getting really overwhelmed by,
The number.
oh, 25 times, 20 times, my,
And
because,
yeah,
like, for
I think
example, in Europe, it's probably much lower,
Yeah.
multiple, because you have the social security, you have,
Right.
like, for example, in US, I always see people need to have 6 months of runway, because
Right.
you don't know when you're going to get fired, or you don't know when you have a healthcare expense and you need to plan for
Exactly.
it. In Europe, like, you don't need to think about those things, because there is a, like,
Like a safety
unemployment
net.
benefit,
Yeah.
and there is healthcare, you don't pay anything. Like, so I think depending on the situation, you need to reevaluate each. A lot of times these numbers could be a lot smaller than what people think it might be.
Yeah, and I also think we just like to over index, right? Like we see that number. It's just the only thing measurable. So we just like I think it's a human behavior of just procrastinating till I reach that number.
Mm-hmm.
I don't have to worry about anything else. I don't have to worry about what I enjoy doing, what will I do with all the time that I'll get.
Mm-hmm.
Because that number is right there. Like
Mm-hmm.
I can see the paths to there, like 10 years, 12 years.
Yeah.
And I think that's our way of fooling ourselves.
Mm-hmm.
Just by that number is the most important thing ever.
Yeah.
And usually when people get closer, they're like either two things: they're not ready.
Mm-hmm.
They realize, oh my god, this is okay. I've
Mhm.
made the money, but what will I do with the 10 hours more plus I get every day?
Mm-hmm.
Or they just change the goalpost, saying that actually I need more.
Mm-hmm.
Actually, I would like a different car.
Exactly.
So they just basically I think it is this fire just gives them a legitimate way, a
Mhm.
verified way of saying that yeah, I need to double down on things and work this hard. But you have seen fire, like you saying it's realistic for people, but it's a different kind of work than just reaching that number.
Yeah, I think there are multiple dimensions to it. So
Right.
one is the money, the other is your purpose, the other is, of course, your time, and the other thing is also, like, how do you derive meaning out of
Yeah.
all of this, and what do you wanna, how do you wanna, like, help people around you,
Right.
like, do whatever you can do best, etc. Like, I think those are all additional dimensions
Yeah.
that, like, you need to think about it holistically. Money is just like a small component,
Right.
and because once you reach that, there's this emptiness of everything else, which you need to prepare for way ahead of time. Yeah.
Exactly. Talk to me about this concept that they say that money doesn't change you; it just amplifies who you are.
Mm-hmm.
So essentially, help me understand, like, how do you change, or how do you get amplified when you start making more money? What have you seen that happens to people, like for example Luxembourg, which is one of the richest countries in the world? What happens when they run into money?
I think in general, the underlying statement is so true. Money just amplifies, you know, i- innate personalities of people.
Yeah.
If somebody is a very kind person, more money just makes them kinder, even more kinder. If somebody is used to, giving, helping people, finding ways to help people who need support, etc.
Right.
Having more money will just amplify that even further. If somebody is not a very nice person, and
Yeah.
like they having more money just brings out more of that. Like, I think that's just a general human behavior, thing. And I think the other thing is also people, they have their own, inner desires,
Ambition.
ambition, and, inner idea of who they are.
Right.
And that comes out more readily once the money problem goes away. Because there is
Like the
always
freedom,
this,
right? The freedom to do.
yeah, exactly.
It's really funny. I was interviewing this guy, Philip, and we were talking about a person who went to a very rich guy's Airbnb. So the rich guy owned the Airbnb, and all the switches were on the floor for all the lights and everything was on the floor because that guy was a germaphobe. He didn't want people to be using. And so what Philip was saying was that everyone is weird. Is this when you get rich, you can afford to be weird?
That is true. Yeah.
Right? Like, I like to wear shorts. Do I have to wear suits? Yes, because I'm a corporate guy. Like, I need to wear. Once you become the boss, you can wear shorts. So in that way, that weirdness, you're no longer trying to hide it, I feel.
Yeah, that's true.
Right.
I think you could make moves towards who you really are
Right.
much before you have the money as well.
Yeah.
But of course, in some situations the circumstances may not allow for you to, like, for example, like wearing a shorts, and like if you are a banker facing customers, like of course you can't show up in shorts. Like, I think those things become easier. But I think I think the important thing is, once you figure out, like even in my own investing journey, I think figuring out my own personality and how I behave, it was the most important component of figuring out my investing. Because once I know how I behave, then I know how, what makes sense for me.
Right.
And that's also why I think it's very important not to get carried away by all the noise in the system. Because, for example, if you are a patient investor and if panics don't affect you, then you're likely to be a much better investor. Because when everybody is panicking, when there is, blood on the streets, you're just calmly buying.
Right.
Like, none of that really bothers you because you've done the work, you've done the research, you know the company. You're like, okay, so I would really have the CEO marry into the family. Like, once you have that level of comfort in a business, then none of the panic really matters, because like how solid the business is. I give this example, like, during COVID times, there was this period of stocks getting really beaten down. I'm like, nobody's going to stop buying underwears. Like, in India, Jockey is a big publicly listed company, and nobody is going to like stop buying underwears because for example, when India had the government change, the election happened, and then the ruling party came back to power, but the number of seats they had was not a majority. So they had to get support of the coalition partners to be able to form the government. I think that one day the market fell like 10-12% or something. And some of the businesses that got beaten down in that 10-12% fall was businesses like Jockey. Like, or like nobody is going to buy, I don't know, like less underwears because, a new government came. Like, so that's what happens in the market though. So people panic.
Right.
Everything gets beaten down. Like, it's like, the baby gets thrown out with the bathwater scenario. And that's when you as an investor, you're like, okay, this makes no sense in terms of valuation. And there are times you find companies for the whole company is valued at less than the cash the company has in its account. Like, makes absolutely no sense.
Right.
And those are times you as an investor, you need to be greedy. Like, just buy as much as you can.
Yeah, I think it's like basically maintaining baseline, right? That's something I noticed about myself as well. When my stocks would be down like $60,000 in a day, I couldn't care less. And that was so weird to me because I'm generally a very anxious person. And that's why I also didn't want to do trading because I'm by default an anxious person. Why do I want more anxiety? But when it comes to money, it was such a strange feeling. I would tell my family, my dad or my brother, just for fun, when I lost 60,000, they'd be like, I could feel palpitations through the phone. And I was like, I actually don't care. And
Exactly.
a year later, there were some days I would make like $50,000 in a single day.
Yeah.
And I'm the same. I'm looking at it. I'm like, oh, interesting. I'll tell my family. And they're like, oh my God, you made 50,000. And they're again palpitations. I'm like, this is so strange. I feel no emotion.
Exactly. I think that's a lot harder for most people.
Yeah.
And that's where I think the challenge comes in. People panic sell, panic buy, like all of this fear of missing out. Oh,
Right.
everybody is buying this. This is going up and up. Like, I need to buy this. That's never a good idea.
Yeah.
So you need to be very grounded and be able to, like, going back to the same example of real estate purchase, right? Like,
Exactly.
you need to have that mindset of, like, am I buying this house at the right valuation?
Yeah.
Like, does it have all the things that I need, etc. So
I think
that's
it
how
also
you need to think
suits
about.
the 9 to 5. Like, you don't want another job of investing, right? That's what I feel is it was so well suited that you don't have to open your brokerage. You make 2 decisions a year. And you're learning and being curious, which is for some people a lot of fun. Like, I would like to go around this block and be like, oh, you own a lemonade stand and you own a car company. How does it work? And with that approach, it just becomes so much easier. Where I see the other people who are, way ahead of me in their net worth and stuff, super stressed around money.
Yeah.
And I'm like, oh, are we like in the same world? Like, why is this stressful to you? So, and it makes a lot of sense to me to go this way because I don't want, my 9 to 5 is already stressful. Like, I'm trying to, grind through it. Why do I want another piece of stress? And I think people get it backwards and, they get the stress from investing and then they're trying to make more money at their job and there's, and it's just a vicious cycle they're going in.
Yeah.
So I feel that way that, maybe I at least got lucky that early on in life that I'm like, okay, this is super. Like, I was out for 4 months traveling with my family and on a paternity break. I didn't even open my brokerage account.
Exactly.
Today I was fighting with my bank account in India because it has been locked for 4 months. Every time they ask me to do a KYC or something, I'm like, okay, sure, I'll do it. I forget about it. And I was like telling somebody today, for example, I have about 20% of my cash sitting in a checking account. And that guy's like, oh my God, why don't you just press a button to move it to savings? You'll make 3%. I'm like, but that's what I'm trying to explain to you. I wanted to reach this level so I don't have to do these optimizations for $3,000, $5,000, $10,000 a year.
Yeah.
I agree with you. What you're saying makes total sense. I would have been like flabbergasted if that was like 7 years ago when I didn't have money.
Yeah.
But now I am actually proud of who I've become on that journey.
Yeah.
Of being like, okay, I just wasted a few $1,000s and that's okay because you were doing something else which was more important.
Yeah, exactly. I think
and it's so freeing.
Yeah, exactly. I think lot of that mental clarity comes from building the knowledge.
Right.
So once you build the knowledge, it becomes, so easy. But when you don't understand what's driving the stock price up or down, then of course you're in panic all the time because, you don't understand why it's happening. So, it drives you towards, all sort of reactions because, you just don't know why it's happening. So I think like your mental clarity as well, I think it comes from the fact that you have this underlying knowledge of why these things are happening, like what is my investment, like, so that's what drives the
decisions.
And also, like Warren always says, right, like temperament is more important than IQ. Like you can be a super intelligent, but I think there's even a
probably it
story
even
of,
harms you.
Yeah, there's even a story of, I think it was Newton.
Newton.
Yeah,
He said
Newton
physics
lost
is
money.
very. He said
Yeah,
physics is much easier
yeah,
than finances.
because
Yeah.
like Newton actually lost money in the stock market.
Right.
Like, you
On
know,
these
one of the greatest brains.
East India Company voyages bets,
Yeah,
right?
yeah, exactly. So
What does money mean to you, and what's your goal? Like, what are you trying to do with this? Because you are working in tech, 15 years, like veteran at Amazon. Help me understand, like, what is your goal apart from the personal, financial money you'll make? What is your goal, and what does wealth mean to you now?
wealth equals freedom of choice. So it helps me decide what I can do with my time, what I can do in my future. And so the way I think about it is, I know that like at the current rate that I'm going, that'll be more than enough wealth that we actually need. So what that means is there will be a point where, once I have enough for, my family, then everything else should go back to whoever needs it, right?
Yeah.
Like, in some form back to the society. That's how I think about it. And that's where, like, I work with, some friends,
Right.
and, who are working on, various nonprofits and various organizations that are supporting people, who need that support. And that's where I think money should go. I do this
Like
because
this-
it's fun, I enjoy this,
Yeah.
etc. But I don't need
Right.
anything beyond, whatever my number is, right? Like, and I know that, based on how compounding works, the more years you live, like, it's going to just keep compounding. I just don't need all that wealth. And giving money to your own bloodline, your own kids, if you give them too much, you make their lives less interesting.
Right.
So of course I'll give money to my son, and as he grows up, like, if he's buying a house, like, I'll support with the mortgage, etc. But I'm not going to leave millions for him,
Right.
which would make his life less interesting. I think the journey is the interesting
Right.
part, and he needs to figure that out on his own. Like, my
Right.
goal is not to give him plenty of money.
Yeah.
We will have enough
Exactly.
to take care of our life, but everything else will go back to society.
I think of that as an example, right? I remember, like, if you're watching your favorite show that you've been waiting for it to come out, season 1 comes out. What if your parents or your friends just made you watch the last 10 minutes of the whole season?
Mm-hmm.
And you're like, okay, now I know what happens, but where's the fun?
Exactly.
The point is not to just get there, right? And it's
Yeah.
actually frustrating
Mm-hmm. Mm-hmm.
that it is a very different experience, right?
Yeah.
Like, of you hiking somewhere, or you just take a cable car and you reach the top, you have the same view.
Yeah.
But man, like, the amount of endorphins and stuff that you go up, it's just how we are trained, and you can't just take it away from.
Yeah.
And I think money is a great motivator. If you just hand over a lot of money
Mm-hmm.
down,
Mm-hmm.
I mean, they can still find purpose.
Yeah.
It's not like every billionaire's kids are like drug addicts and stuff, but I think it's just way harder challenges than for them to, find things to do.
Exactly. That's how I think about it, right? Like, my family will have enough. Anything beyond that definition of enough,
It's probably
I
counted.
don't have any use for it. Like,
Right.
I really don't have any use for it. Like, that's
Right.
how I think about it. And this is also shaped by how Buffett talks about
Yeah.
wealth to kids, etc. Bob Bry talks about it as well. Like, and my thinking is shaped by
Yeah.
like what I have learned from all these great people in general. And I agree that's the right way to go, and that's exactly how I'm thinking about it. And that's also why, like, I spend a lot of time working with people who are working on making the society better. And the reason I'm building, I'm doing a lot of work in that area, like, with nonprofits, etc., because that's where I eventually see a lot of my wealth going into. So
Right.
I'm building those relationships way ahead of time to make sure that eventually, the money has a good home to go
Yeah.
to. Yeah.
And that's super fascinating. And could you, in the end, just give us a breakdown of your 100? Let me see if it comes back on.
Mm-hmm.
Yeah. Looks like, at least on YouTube, we're live. Okay.
Okay.
I think we can probably end it soon. And
Yeah.
yeah, so can you give us a breakdown of your investments and cash and your retirement? Like, how roughly is it structured between the 100%?
Sure. So I don't have like separate buckets. So all my money is pooled into like one bucket and then it's allocated. About 60% is in India, 60 plus maybe like 70% almost is in India. And then the
Invested.
remaining, invested in India, in the Indian stock market. And the remaining like 30 plus percent is in international. When I say international, it's US, Europe,
Yeah.
and a couple of things here and there. But and of my entire wealth, I would say roughly about 75% is in just 3 companies. So I'm heavily concentrated.
Right.
And the remaining like 25% of my wealth is in maybe another 10 companies, I would say.
Wow.
So the total wealth is like distributed between
Yeah.
like anywhere between 12 to 15 companies in total, I think.
Right.
Probably.
And that
Some of the
3 are
portions
the
are-
majority of
Yeah,
your-
3 are like just
Right.
the major investments. And cash, I try to be at like about 10% cash at any point in time, and it's not a conscious decision.
Yeah.
So the way I do it, right? Every month from my salary, money keeps going into my brokerage account. So I have like a
automated
thing set up.
Right.
Like it just goes into my brokerage account and it's sitting there as cash.
Right.
Like I don't keep anything in the bank
bank
account
account.
because like
Yeah.
no point. Like so that reason it keeps going to my brokerage account is the cash in my brokerage account keeps going up, and I'm never buying. And when the opportunity strikes, that's the time I'm most active.
Right.
Like if stock market crashes like 50%, then like those couple of weeks is probably when I'm like
Right.
making all the buy decision. And the decision is already made several months ago, several years ago, based on reading annual reports, etc. But the action of executing it is happening
delayed.
at a opportune
Interesting.
time.
Yeah.
So that's how I think about it. I hardly ever sell unless the underlying thesis like fundamentally changes a lot. Like I wouldn't sell because I'm not buying companies that are that I need to sell. So again, there are different ways of investing, right? Like think about like a Swiss knife approach. Like you have so many. So one is essentially buy great companies, buy them at great price, and just leave them alone
Right.
as much as possible. The other one is where you have these opportunities where market just like disproportionately misprices some
Right.
business. Those are not your long-term holdings, but it is just like free money,
Right.
which you don't want to say no to. So I think like about a 10% of my portfolio is kind
Like
of
that.
something like that,
Right.
where none of these questions I will hold forever, but until the market realizes the real value of
Right.
these businesses, I would hold them. And then once my thesis plays out, I would just,
Yeah.
exit out of them, and that stays as cash till I have, more
The
opportunity.
next time.
Yeah. Yeah.
And what
That's
has
my
been
point.
your rate of return roughly? Like what would you say?
I don't I personally never check my specific rate of return. I think like the Indian brokerage account allows me to check how does it do against the index. I know I have beaten the index over the last like 6-7 years
Wow.
or so. I don't even remember by how
Yeah.
much.
And the index is like 8-9% last 5-6 years. Indian index.
No, India index is much higher, right? Like India has delivered anywhere between like 14-15% over
wow.
the over.
That's crazy.
But that's also because Indian rupee
Yeah,
against
yeah.
the dollar, etc. Right? Like so, there's a lot of nuances to it. But all I look at is it shows up the chart over many
Right.
many years, and the line of my portfolio is it better than
Right.
line of the index. I do the same with my portfolio for other international
Right.
stocks as well.
So that's your objective metric of measurement.
Exactly. I think it makes it very clear on whether should I continue to do active investing. Of course, I enjoy the process of learning.
Right.
So it's very fun for me. So even if my return is meeting the index or slightly lower than the index, I would continue to do this
Yeah.
because I just enjoy doing
Yeah.
this. But at least for now, like
That's amazing.
I don't know, like, and these things you never know, right?
Right.
Like maybe I just got lucky with some of my early investment,
Yeah.
which ended up doing 5x, 10x, etc. Then maybe you're just lucky that's playing out for a while, and maybe I'm not that good. Like I just don't know.
It's very hard to say as well.
Yeah,
And I think in the
yeah.
shorter period,
Yeah.
maybe it's even harder.
Yeah.
But it's very objective to compare yourself to index, right? Because you could just a baby could do indexing.
Exactly.
And you're just saying all the effort that I'm putting in, is it adding even a little bit value? Apart
Yeah.
from the fun, and if you enjoy it, that's different.
Yeah.
But is it adding any more alpha to your any
Exactly.
advantage? If it's
Exactly.
not, then be self-aware and be like conscious that
exactly. And I think I know what I'm doing. I know I'm not speculating, and I enjoy the process. I think that's what matters. Like
Right.
Everything
Absolutely.
else is
Thank you, Shankar. Where can people find you?
LinkedIn. I never used to use LinkedIn like several years ago because I never had any thoughts about finding a new job,
Yeah.
etc. More recently, because I took educating people on like financial literacy as one of my personal mission, I started writing on LinkedIn quite a bit. So LinkedIn, Twitter, those are
Awesome.
probably the places.
I'm so lucky that you came across at a very important point of my life and helped me make a lot of money, but also just way more than money. You helped me build a mindset of like long-term thinking and long-term business honor. So thank you so much, Shankar. It's been a pleasure, man.
I still remember our first ever conversation, like having coffee and sitting in that building.
I know. Are you Shankar? Like, remember coming to you. I don't see any questions, so I think we can.